So today I'm going to talk about different types of investing or styles of investor, and they can include value investors, speculative investors, dividend investors, and people who are just having a good old punt on something and see what happens. So let's have a look into the first one here. Let's click on that one there, and that should come up. There we go. Tesla. Tesla's a classic example of a speculator's share. The pricing is currently sitting up at $1,500 a share. During the recent crash, it dropped down to $280 very briefly, and it's just soared back up again. There are some YouTube speculators saying that this price could go up as high as $7,000 a share. But for a company where there's no PE ratio, so they're not paying out any money. It's a bit like the dot-com bubble, and the price can go way up, and all of a sudden someone goes, oh, hang on, and the price can crash back down again. Lemonade, there's another example of it. It had an IPO last July time at $29 a share, and now up at $80 a share. It was up at 87 at one point. This is an insurance company, an insurance broker, basically, just marketing themselves as a fintech company, and trying to jump on that bandwagon, but they're in debt. They're not making any money, and the price just bears no relation to the true value of the business. But maybe in time it could be worth an absolute fortune. I don't know, but it's a speculator share at the present time because there's really nothing to go on. Have to see if the price dropped down a long way, and so. But anyway, let's have a look here. So here's more a good classic value investors type of share. A value investor is someone who likes to buy a business when they're on sale, but they're a good solid business. They're investing in the business themselves. Greggs, as an example, sell sausage rolls and sandwiches and coffee, and they've changed from being a little bakery chain and have grown a vast number of stores across the UK, and with a pricing there at over $2,500, which has come down a bit. It's about $1,500 at the present time, and had dropped down to about $1,300. It's a good solid business that if the doors were fully open would be back on the $2,500 mark very comfortably. So yeah, it's a popular business. It's got a good moat. It means it's got a good strong brand. It's got a nice unique proposition in the marketplace, and does very well. Not a lot of, there is competition, but not in the same path. W.H. Smith, on a similar note, is known by the city as a chain of bookshops that's been around for a long time, but they've diversified, and they're now holding Marks and Spencer's food hall outlets in service stations and airports, as well as probably the little chunk I'm interested in, which is a Costa Coffee franchises, and they've been taking on quite a few of those. Again, in good locations. So I personally feel that the share price is probably quite undervalued to really what the business is doing and how they're diversifying and growing again. So it's a value investor's share, but when it's on sale at the right kind of price. Let's have a look down the list in here. All right, British Telecom. This one's a classic dividend investor's share. So look at the pricing. The share price had been up at 500p a share and has dropped down at the present time to £1.12 a share. Really, because what happens with many big dividend payers is they build up a lot of debt over a long period of time, and then suddenly realise, well, we can't really pay the dividend anymore. We need to pay off the debt and restructure ourselves, and that's what they've done. And a lot of the dividend investors have gone, I'm either caught with a cold at £5 a share, or have held on, and their shares have absolutely plummeted in value, and they're going to have to wait a couple of years till British Telecom decide to pay a dividend again, and it may not be at the high levels it was in the years gone by. So it's a classic dividend investor share, and you need to be aware of the dividend trap. Now, let's see what else we have here. So it looks right down the list. There we go. All right, so I've got shares in Costains, as well as Kier, which I'll talk about in a moment. Both have had a few little financial difficulties, but the share price compared to what they used to be, like Costain there again at nearly 500 a share, down to just about 60p a share, and Kier on a similar basis, 1,500 and down now at 69p a share. They both had a few problems in the last year, but I really do feel they're interesting because of one way they used to be, and the HS2 rail project, which over a long period of time means their businesses are set to have a really good income, in terms of the sorts of projects they're involved in. So, yeah, it's being although aware of the debt, it's something I'm interested in. Lloyds Bank again is a reasonable dividend player, and they come down from 87 pence and tumbled all the way down to 30 pence a share. Again, they've stopped paying the dividend, and they won't be paying any dividend until next year. At which point the share price may well jump back up again. Obviously, you need to do your own homework on any shares that I'm talking about here before you make your own investment decisions, or consult an advisor. So it's purely for entertainment purposes. Revolution Bars. This is a business where the share price had been quite reasonable and dropped really quite low. Bounced back up again on the expectation they might be opening the bars again, but are only going to open about half a dozen, and the share price is really reflecting that. And a business with quite hefty debt levels means it's a bit of an ouch. So you really need to understand the sort of businesses you're looking at and investing in. Let's have a look there at Aston Martin. Aston Martin's quite do a bit of Royal Mail. Here we go. Royal Mail, I'd bought in about £1.25 a share when it was quite low, and I sold out at £1.45 and thought, there's a strike coming, and the strike hasn't happened. They postponed it, and the share price has gone on up to 180. But it used to be at 630 pence a share. So if they get their restructuring right in the long term, Royal Mail could be quite an interesting one. But it was a good dividend payer, and let's see. See what else we got on here. Rank organisation. Rank known for Mecca Bingo and the casinos chains. Sitting at 145 a share at the moment. A good, solid business. It would be really, really great if the doors are open. Unfortunately, they're not taking any money at the moment. That's really being reflected in the share price. So at the moment, is that a value investor share? I think it possibly could well be. Once those doors are opened and the tills are ringing, away we go again. Kingfisher. Kingfisher is B&Q and Screwfix for DIY and garden centres sort of combined. Sitting there at £2.54 a share. Earlier in the year, they dropped down to about £1.20 or so a share. With all the stores closed, and now they're open again. The shops are open. Everyone hit the DIY stores and the garden centres, and the share price has shot back up again. So good quality investment there. And let's see what else we got here. And their restaurant group. I think that's probably one where people really need to do their homework in terms of who's running a business. The guy in charge at the moment was running HBOS, which unfortunately was a major financial disaster a few years back. And with the restaurant group, their share price, they used to be a very big chain, really. They've closed all the Frankie and Benny's. They've closed the Chiquitos. They own Wagamama's, which are open and I think are taking some money. But the share price has taken quite a big old hit. But with so many restaurants closed and no plans to reopen them, I think he's just borrowed a load of money from Lloyds Bank as well. So it's I don't know. I think Lloyds might have been realising who was borrowing the money, going, oops, maybe not, but they have done. So there we go. We shall see. So make sure you do your homework before investing, and if you like what we're talking about here, like, comment and subscribe, and we'll catch up with you all again soon.